Good morning, everyone. Welcome to the video edition of Traders Espresso for Thursday, March 1st, 2018. And February is now in the record books, and February was a down month. It was the first month down for the Dow and the S&P since March of 2017. The NASDAQ 100, NASDAQ Composite, and the Russell had down months more recently. Somewhere around like August, September, or something like that. So the winning streak for the S&P and the Dow has now been snapped. There is a slew of economic data out, and I don't use that word often. I enjoy the fact I get to use it today. But there's a lot of economic data out, and as far as the futures are reacting, they're basically maybe pointing to a mildly positive open. I mean, it's, the Russell futures are flat, the S&P futures are flat, basically the Dow futures are flat to negative. Russell flat to negative now, S&P flat to positive. The NASDAQ is the only one really, showing that much strength. It's up almost 0.2%, okay? The numbers that come out today are some inflation numbers and some jobless claims. So let me just go through here because there's a lot. Basically, everything's coming in at or slightly above expectation. Okay, the PCE, which is personal consumption expenditures, it's a measure of inflation. This is not the core number. The core number has energy and food stripped out of it, but the PCE price changes, consensus was 1.6%. They came in at 1.7%. The month-over-month number for that same thing was 0.3 consensus, 0.4 was the print. Personal spending, 0.2, and it came in, was the consensus, and it came in at consensus. The personal consumption expenditures, personal spending number, which is different than price changes, the consensus was for 0% change. That came in a little hotter than expected, 0.4%. Previously, that number printed at 0.1%. Continuing jobless claims, a little bit higher than expected. 1.93 million was the consensus. 1.931 million was the print. Core PCE price changes and PCE personal spending was 0.3 and consensus, and it came in at 0.3. And then the annualized number, what I'm going to use just the core PCE. 1.5 annualized, and it came in, was the consensus, and it printed at 1.5. The previous read was 1.5 also. I read you continuing jobless claims. That was the 1.93 versus the 1.931 print. Initial jobless claims, the expectation was 226, and those came in lower than expected, 210. So that would be symptoms of an economy that is healthy, bordering on overheating. In 45 minutes, we get the market manufacturing PMI number for the U.S., and we get in an hour, we get the month-over-month construction spending and the ISM manufacturing PMI prices paid. In addition to that, Jerome Powell, the Fed chair, will be delivering testimony to the Senate. He testified on Tuesday to the House Financial Services Committee, and basically his view was a positive, optimistic one. I don't think the stock market is taken as very optimistic, because him saying things like the FOMC, we need to get together and revisit our rate path because a lot's changed since December or January. The market didn't take that very positively. We've had 2 down days in a row. So Friday was bullish, Monday was bullish, Tuesday, Wednesday started out bullish, but Tuesday and Wednesday both were pretty vicious days to the downside. A bigger downside day for the Dow on Wednesday than it was on Tuesday. Tuesday, the Dow closed down something like 299. Yesterday, it closed down almost 400. So as far as what to expect today, I mean, again, there's more data coming out. We get the PMI numbers coming out. we get Jerome Powell's testimony before the Senate. I don't know what's going to come out with the Senate that would be that different than what he, talked about with the House. But you never know. I mean, if somebody asks some more, pointed questions that elicit a response, with which Jerome Powell feels like he has to elaborate, then, there might be some surprises. I wouldn't necessarily expect any. So I'd focus more on the data. I'd say right around, market's going to open in about half an hour. Right now, like I said, it's pointing to a mildly positive open, but we'll see. I am going to show you I am going to take a little bit of a longer term view here in a second. I do want to get you updated on what's going on just in other markets. Asia didn't take yesterday's market news coming out of the United States. Asian markets did not take that well. Asian markets were mixed. The Kospi was down a little over 1%. The ASX the Australian market was down 0.7%. The Nikkei was down 1.5%. The Shanghai and the Hang Seng were both up 65 basis points and 44 basis points respectively. As far as Europe is concerned, Europe was down across the board. The French CAC was down 85 bips. The German DAX was down 1.3. The UK FTSE was down 63 bips. The European Stoxx 600 was down 84 basis points. On the commodities front, energy commodities are down across the board. And from metals perspective, metals are also down across the board. Gold is down 0.75%. Silver is down a little over 1%. Copper is down about 0.25%. So not quite as bad as it's been. But palladium is down 2%, and platinum is down 2%, and palladium is down almost 4%. So that is a big move in palladium. Platinum and palladium they kind of straddle that world between precious metals and also industrial metals because they have industrial applications just like copper does. Although copper is more purely the industrial play. The US dollar index is up 12 basis points right now. The yield on the 10-year note is down 0.7%, so it's down to 2.848. That's what the 10-year yield index is telling us. And actually, yields are down across the board with the exception of the Japanese 10-year. That one's up 0.005. Now, I did say I was going to show you the monthly chart. This is the monthly chart for the S&P. It looks the same for the Dow and the Russell. It's a little bit different for the NASDAQ, and I'll show you that in a second, although not dramatically so. So you can see that if I zoom in here, with our first down month in February for the S&P, we now have a confirmed bearish stochastic crossover on this histogram here. Okay, and we can see the fast and the slow stochastic having spent a significant amount of time in July of 2016 up here in overbought territory. Now we're going to drift down. That is a bearish signal. If I look at the Dow, it's the same thing. If I look at the NDX, it's not showing a crossover. It is showing deteriorating momentum to the, deteriorating positive momentum, as you can see here. And there's been some areas like here in October of 2016 where it deteriorated. There's a little bit of a correction here, not really a correction, but you get the point. And then some, strengthening in momentum, another weakening, more strengthening, and now this histogram is the closest it's been to zero in a long time. Okay, probably since December of 2014, which is also when the yield curve started flattening. I'm going to get to that in a second. So if we look at the past, when there has been a confirmed crossover in that stochastic histogram, it's usually been followed by a few down months. And I don't think that we should be surprised this time at all if that happens. If we look here in 89, we had some trouble here. If we look here in 1994, Same thing. Go back to any of the recessions, right? The dot-com bust, of 99 and 2000. Okay, 2001. So every single one of them, excuse me, has been preceded by this stochastic histogram doing a negative crossover. Here's 2007, 2008, right? Generally speaking, how high the amplitude is on the positive side, eventually you see about a similar mirroring amplitude on the negative side. That's not always true. If something like that holds true, then we would expect this to be probably a little bit more of a mild correction. It's not been preceded by a whole lot of positive momentum. I definitely don't think that we're going to see anything near as vicious as 2007 to 2008 and 9 were. We have a strong economy. We're not. There isn't any catalytic event like mortgage defaults and credit default swaps and things like that. But we are going to see. This time it's not going to be. If you hear this time it's different, just shake your head, because it's not going to be different this time. All right, this is going to play itself out. The market is pricing in that Jerome Powell and the Fed are going to stick to their guns. This Fed is not going to nursemaid the stock market anymore. I think Jerome Powell made that very clear yesterday. Our only tool is monetary policy. We're not going to pass judgment on fiscal policy. We're going to stick to our mandate. We're going to track the measures that we've always tracked. If fiscal policy is expansionary, we have the monetary pool. And it creates, economic imbalances. We have the monetary policy tools that we need to fix it, and we're going to use them. We have the wherewithal to use these things. So I don't know that you're really going to hear anything that different from Jerome Powell. Now, one point I'll make, and then I'll shut up here, is, I was reading last night something that I'm trying to remember the name of the St. Louis Fed president, James Bullard, in December had basically advocated that the Fed should take a little bit more of a cautious approach to tightening up monetary policy, because he said when yield curves flatten and then invert, it's usually a precursor to a recession. There's only two ways for us to prevent this from leading to a recession. Number one is policymaker, and this was his preferred option. Number one is for policymakers to be cautious in their approach to tightening monetary policy. Number two is that the market, that yields need to increase at the long end of the curve, and the market, in order to catch up with policy rates, and the markets need to do that. Well, guess what? Markets are doing that right now. If you take a look at this picture that I'm hovering over right now, this is a comparison of the yield curve in December of 2017 from a year prior. Okay, and you can see this crossover. This green line is what the yield curve was at the time. This dark blue, purple, whatever you want to call it, yield curve was the yield curve a year prior. So a steeper yield curve a year prior, a flatter yield curve at the time that Mr. Bullard expressed his views. Okay, if we take a look at now, this was 228, so yesterday compared to a year prior on both a real and nominal basis. This is the nominal yield curve here. We can see that that cross has fixed itself, that the long end of the curve has corrected through market forces. As bonds are selling off, yields are increasing. I've heard the word rout used when it comes to what's happening in the bond market. Well, if that's a rout, then guess what? There's going to be more of a rout, because I think this is going to continue. I don't see the Fed backing off. Especially in light of the fact that Tax cuts have been passed. They're working their way through the economy. We're going to continue to see positive numbers. The Fed doesn't want to choke off growth, but they're not going to let it run out of control. Now, the only thing that Jerome Powell said yesterday, which could be cold comfort or some kind of comfort for markets, is that 2% is our inflation target, but there can be a little bit of give there. I mean, 2.25%, 2.5% wouldn't really cause us to panic. So if we start seeing, inflation numbers hit 2.25%, that might be a concern, but there is a little bit of some give there. Anyway, as far as today's markets, like I said, it's going to be largely data driven. I wouldn't be in a position prior to data coming out. I would probably pay very close attention if you have CNBC or Bloomberg or something like that, where you can watch and listen to Jerome Powell's testimony before the Senate. I would do that and pay attention to what markets do. I'm not saying don't trade today. I'm just saying be cautious. Right now VIX is elevated 1.3%. It's not nearly as nearly as large of moves as it was yesterday and the day before, but it's still elevated. So have a great day, everyone, and good luck trading.